Hey guys, welcome back. In the last video, we briefly touched on the importance of institutional interest, and now we are diving in a bit deeper and getting more concrete. Who exactly are these institutions? What are they doing? And most importantly, how we can profit from it. So let's put a name on them. By institutions, we mean the banks and the hedge funds and the pension funds. Quite simple. And the common theme for all of them is that they all have serious resources at their disposal that are just not available to the common man. Don't get me wrong, we, the retail, have our strengths, but market foresight is just not one of them. So instead of struggling against the nature of the game and trying to be the quote-unquote whale, we fully embrace our nature as those tiny little bullshit fish that follow the whale around and eat what the whale misses. Tens of thousands of dollars falling by the wayside is, of course, nothing for the whale, but the tiny fish can live pretty comfortably by it. Now, the largest of these institutions can't just slap the buy button once and be done. They accumulate carefully over time, all the while trying not to tip off the whole world what they're doing. So whether they're executing orders for their clients or just rebalancing the portfolio for exposure, the execution desks are highly incentivized to acquire shares at the best possible price in the allocated time window. So depending on the time horizon they have for the execution, they can plan out those buy and sell campaigns very carefully around major news events, earnings, major technical points, etc. By the way, this will all be an important theme later on when we get to entry points, because it is very common for us to use their shakeouts, where most weak hands fall off, to actually join them in their buying and selling campaigns. But the key takeaway here is this. For them to actually enter or leave a position is a long, drawn-out process, which can take from several days to weeks. And it just doesn't just appear on our chart as one big green or red bar, and that's it. There's actually a certain quote-unquote dance that the stock is doing when institutions are backing it up, and it takes time for that dance to play out. And this is of course great because it allows us room to spot it and join them. So here comes the big question. What are the signs of institutional interest? How do we go about it? Well, we begin by looking at things that can't be hidden or faked. First of which is volume. Now, I know dark pooling is a thing, but for our intentions and purposes, it is irrelevant. Just to be crystal clear about this, we are not interested in a sudden burst of volume that happens when stock reaches a support zone and there's a ton of supply and demand waiting. Instead, we are interested in rolling volume that is starting to steadily outpace the stock performance of previous days. So in the next video, we will go through some practical steps, but for now, just please keep in mind the following. The best setup in the world means nothing if the institutions are not looking at it. And if they are looking at it, there's going to be volume. Plain and simple. The second thing we look at is divergences in price action compared to the market or sector. Because of the underlying market mechanics and how it's self-regulated, there is huge pressure on each stock to fall in line with its peers. Meaning if a sector leader is going up, chances are the sector peers are going up as well. And doubly so if the market at large is going up. Now, the best way to see whether a stock is being held by strong or weak hands is to see how reactive it is to these daily fluctuations. There's actually nothing better for spotting institutional interest than a huge green or red day on the market, because the stock that actually has institutional interest will for the most part be totally unfazed. That extra selling or buying pressure will just get soaked up and the stock is on its way. And lastly, we look for clarity of movement. Each stock has its own personality in the way it moves, but if institutions are backing it up, the movement is going to be controlled and orderly. The reason behind this is that the institutional algorithms that are doing the buying and selling of shares have a very structured set of rules, mostly defined around moving averages, VWAP. So if the stock has high volume, but price action is all over the place, just stay away. This usually means that there is conflicting views on the company's projected value and uncertainty among the strong hands. Our strategy here is very simple. Just wait for the dust to settle and join them when one side wins and the price action is clear again. So let's stop there for now. Hopefully we are leaving the boring theory land behind us, and beginning with the next video, we start with the practical stuff. Yay! So let's move on.